Okay, so you are welcome to the class, right? I'm going to take standards, and standards, both accounting and admin students, you're all treating accounting standards. So I'm going to take care of the standards, and I hope you understand this at the end of the session. Very good. If you have any question, you jot it down. I'll bring a question, we'll solve it. Then if you have any question, you let me know. Okay, so we are starting. All right. So the first standard I would handle is IAS 23. I think that's one of the standards which a lot of you don't. Quinn, post in the group that they should join. Send a link to the group so they join. Quinn, I've seen you are online. So that your colleague accounting students will join. When are you writing your FR? Quinn, when are you writing your FR? She can't hear me. All right, so let's start. Please pay attention. It's not difficult, okay? It's not difficult. So we are going to deal with IAS 23. IAS 23. And IAS 23, I've seen that it's in most of your questions. They can bring it to any of you guys. Mute yourselves. So IAS 23 is about borrowing costs. I getting it. Borrowing, you have to write, okay? You have to be writing. Borrowing costs. So now, borrowing costs is what we are going to deal with first. I wouldn't teach you professionally, but I'll just take questions and I'll solve them. Borrowing costs is what we are going to deal with now. Okay. So what is borrowing costs? What is borrowing costs? What is borrowing costs? What is borrowing costs? Okay, what is borrowing costs? What is borrowing costs? Okay, so borrowing costs. Borrowing costs, I'm using BD to represent borrowing costs. Borrowing costs is a cost, or borrowing cost refers to costs, interests, and other costs. Okay, interest and it's something we call borrowing cost refers to interests and other costs if you can't see my writing, forgive me. Interest and other costs incurred as a result of borrowing. Borrowing what? A loan. So borrowing cost refers to interest and other costs incurred as a result of borrowing. So it means that these borrowing costs will be incurred when the business borrows money. All right, let's proceed. Now, pay attention. If for us to, what is the recognition criteria? So whenever we are going to teach standards, what we first do is that these are the criteria. One, we have to look at the definition and scope. Definition and scope. Two, we have to look at the recognition criteria. So I've just done a definition. So this one I'm going to look on. Recognition and measurement of the standard. That's the recognition criteria and measurements, okay? So measurements, we have to look at the if there is any subsequent measurement. So let me put all under recognition and measurement. So by 8, I should be ending because I have a class at 8. Recognition and measurement. So definition and scope, recognition and measurement. We have to look at presentation or treatment in the financial statement. How do we record a presentation or treatment in the FS, financial statements? 4, we have to look at the recognition. If there is any derecognition. So I'm going to explain these terms, okay? Whenever there are any standards to be taught, these 5 are followed. Then the last one, we have to look at the disclosure. Disclosure. I guess in it. Disclosure. Okay, so now back to what I was trying to say. I've done the definition and scope. So I'm going to talk about the scope of the. Quinn, have you shared it in your group for your friends to join? Quinn. Hey. Phoebe, share the link in the main group for the accounting. You shared it there.
Okay, sir.
All right. Okay, that's fine. Let's continue. So the definition and scope, recognition and measurement, presentation or treatment in the financial statement, derecognition and disclosure. So I'm teaching you, and then we'll see what to. So I'm first through with. Let me see some people are wanting to join. Betty Wellington. Now, pay attention. I am done with the definition, the scope. Borrowing costs there are so many ways we can describe borrowing costs. But what we are limiting ourselves to per your standard here is the fact that the cost and other interest incurred as a result of what? Borrowing. All right, so let me put it that way. How do we recognize borrowing costs? What's the recognition criteria for borrowing costs? Yes. What's the recognition criteria for borrowing costs? We're on recognition. We're on this one. Number 2, what's the recognition criteria? You have to know, it's theory. 3. So there are 3 recognition criteria for borrowing costs. Recognition criteria. I write very quickly, okay? So forgive me. 1, when the expenditure is being incurred. When the expenditure is being incurred. So please write it. So I'm writing it out because I'm writing very quickly. It might not be very legible. When the expenditure is being incurred. 2, when borrowing costs is being incurred. 3, when the activities necessary to bring the assets into, let me say, its useful use. Useful use, yeah, I think so, are in place or are in progress. So let me explain. When the activities necessary to bring the assets into its useful use are in progress or are in place. Okay, so these are the three recognition criteria. We will say, so these are the three recognition criteria. One, when the expenditure is being incurred, when the borrowing cost is being incurred, when the activities necessary to bring the assets, right, into its useful place. I think it's its useful place. Yeah, its useful place. So place the assets here, the assets into its useful place are in progress. Okay. When we say recognition criteria, recognition, pay attention. This one is general. All of you reading FR, you have to understand it. When you say recognition and measurement, recognition, some of you are not online. It's exams. You just have to be by your phone. You don't know whether some apple will drop, and some of us will may. We have recognition and measurement. Pay attention. So recognition and measurements. This one, and I taught some level 400 students from 8 a.m. to 11. So now, watch. When we say, I'll be using the terms, so I want to explain them first. When you say recognition in accounting, in financial reporting, it means that the item, the assets, the transaction is given a value. It is given a cost. The item is given a value, it is given a cost. And it is incorporated, the value and the cost of the item, I get it, is, hold on. The recognition means that we incorporate the transaction, so you can write it in full, the transaction under the 5 elements of financial statements. What are the 5 elements? I'll go with the acronym ALI E squared. Sometimes I use ALICE, but I'm not using ALICE because we are going to deal with publication, or we are dealing with limited liability companies. So I prefer the ALI E square. ALI E square. ALI E square. So the ALI E square stands for assets, liabilities, income, expenses, and equity. Then the ALICE stands for assets, liability, income, capital, expenses. But I prefer the ALI E square. Are you getting it? So recognition means you are incorporating the transaction under the ALI E square. In other words, under one of the ALI E square. Why? Because if you can't incorporate any transaction under the ALI E square, you cannot prepare financial statement with this. So every chart of account a business opens must fall under the 5: assets, liability, income, expenses, equity. Why? So that the business will be able to report it, capture it into a financial statement. Because we all know that with the ALI or ALICE, right? The ALICE, we have income and expenses, which are used to prepare the P&L. Then we have the assets, liability, and capital, or liability and equity, which are used to prepare what? The balance sheet or financial position. And this is called accounting equation. Do you agree to this? Do we all agree to this? I'm going to start calculation. I'm building you to a certain point before I start with the calculation. So do you understand this? Do you agree to this? Hello? Can you hear me? Can you hear me?
Yes, please, we can hear you.
Yeah, you have to be responding so that I know that you are following. Okay, right. So that is it. So now let me. When I finish with it, we start the calculation. Now we continue with this. So measurements in accounting, in financial reporting, means that we place a value, we place a cost on that financial statement. So if you say that the person bought five computers, the computers, is the person buying the computers to trade it, or is buying the computer for use? If he's buying the computer for use, then the computer becomes a non-current asset. So we have to give the name computer. We have to give the cost, historical cost to the computers. Are you getting it? So the measurement, whenever you hear me say measurement, I mean to say how you value, how you cost something. So the recognition is how do you report it under the financial statement? What title, what description, what narration do you give it? Are you getting it? And then how do you cost it? So under borrowing costs, have you all written this down? I want to clean it. Have you written this down? All right. So under the borrowing costs, the recognition criteria is that you only recognize, right? You only recognize a transaction. You only recognize a transaction as borrowing costs when all these three are in place. What are they? One, the expenditure of the assets is being incurred. That is, the business is spending money to go and purchase the assets, or is spending money to construct the asset. That is one. Two, when the borrowing cost is being incurred, meaning that when that borrowing cost take place, immediately the asset starts, borrowing cost will start running. Are you getting it? So you start recognizing borrowing costs when the business has started spending money on the assets, borrowing costs has taken place, and two, all the activities necessary to bring the assets into its useful place are in progress. So maybe they started the walling, they've started doing this. You see activities going on. So when all these three begin, then you can start charging borrowing costs. You can start recognizing borrowing costs. So I'm done with the recognition. The measurement talks about how you value borrowing costs. The measurement talks about, so number two, recognition and measurement talks about how you value borrowing costs. Whenever I'm teaching anyone standard, these are the 5 steps I follow: definition and scope, recognition, measurement. Then we go to how you can present it in the financial statement. Then we go to derecognition. Then we go to disclosure. Another name for disclosure is called in the notes of the financial statement. So notes. What are the 5 components of the financial statement? You have the what's the name? Financial statement of financial position, statement of profit or loss and other comprehensive income, statement of cash flow. You have the changes in equity, and you have the notes. The note is also called disclosure. All right. So recognition and measurement. Then after the measurement, we'll go through how you present it in the financial statement, which one should be. Then we go to what is called derecognition. You can derecognize borrowing costs. But I don't think it's in most of your slides, so I'll not teach you. I teach that when we are doing financial reporting with the chartered accountant, right? The chartered accountant student. By your level, there's no need for me to, or the MBA student. By your level, I don't need to teach derecognition. So that is out. We are going to start the calculation. I'm building you. So we've done definition, we've done scope, we've done recognition. I'm coming to measurement. From measurement, I go to this. I'll not teach you number 4, but I come and speak on the notes. You are not also to prepare notes. That one mostly is the MBA student or the chartered accountant who you have to prepare the recognition and notes. So these two, I'll just speak on the notes a little. This one I'll not speak about it because it will never be in exams. In exam, they will ask you about recognition and measurement. They may ask you definition of borrowing costs, which I've given you, right? And I give you the scope. It's more about loans. It's not only about loans, but there could be other costs which can be classified as borrowing costs. So we get there. Okay, recognition and the measurement. So I'm on the measurement now. Let's go and pick a question. Then we start with how to measure borrowing costs. Let me calm down. Any question? Now, before you start computing borrowing costs, the borrowing costs, you need funding. You need funds for the borrowing costs. Pay attention. I'll soon start with the calculation, but I want to build blocks first. You should start with the funding. Let me write it properly. You should start with what? Funding. You need funds. The funds, you have what is called okay, we have a pool of funds. Pool of funds, right? And there is one, but I think I've forgotten the term. But let me write here. Okay, specific borrowing. Good, that's the term. Specific borrowing. Specific borrowing. So borrowing, write it on your book. Pay attention. So you are going to borrow a money, and the money you are going to pay interest on that money, and that money is called borrowing cost. That money is a loan. So the funds or the amount you are going to require, it can be a bond, it can be what? Loan. And they are all funds. It can be bonds, it can be loan. They are all funds. And they can be specific borrowing. When we say, pay attention, when we say specific borrowing, we are saying that the source is from only a single source of funding. A single source, it's just coming from one source. Let's say you are borrowing the money from Absa Bank. You are borrowing the money from where? Absa Bank. So let's go to Absa Bank. So what is the single source of funding? Absa Bank. Pay attention. Absa. That's where you're borrowing the money from. Absa. So when you borrow the money, you learned in level 200 on business finance. That is why we mostly tell you that. That's why we mostly tell you that whatever you are studying, don't just study, go and write the exam, because you are going to meet it in future. So you run school, even you go to MBA, you'll be meeting some of these courses you are doing there. So whatever you are studying, don't study just for studying sake. I'm just writing. I'm in haste to go and write, and I'm in haste to go and study and write my exam and pass and go. No, you have to understand it, because you are going to apply. You are going to meet it subsequently. So ABSA, in level 200, you learned about cost of capital. That if you go and borrow a loan, right? ABSA Bank will put a rate of, let's say, 12%. This 12% is the interest rate on the loan. Those who are doing accounting and finance, it is called, if it's on bonds, it is called coupon rate. If it's on bonds, it's called coupon rate. The accountants will do financial management in 400. If it's on bonds, it's called coupon rate. If it's on loans, it's called interest rate. And this interest rate, you did business finance level 200, it is called cost of capital. Pay attention. Yo. Pool of funds. Okay. So pool of funds. Now, let me come here. When you go for a specific borrowing from a single source, let's say from Absa Bank, and you are given an interest rate of 12%, what happens is when you are asked to compute the borrowing cost, you need some items available when it's a specific borrowing. So I'm using brown here. Is it brown? Yeah. Specific borrowing. Pay attention. I'm building blocks before I start with the calculation. So pay attention. Specific borrowing. Under specific borrowing, what do you do? Under specific borrowing, what do you do? You need some items to compute the borrowing costs on specific borrowing. So you say, one, we will need the loan amount. The loan amount, which is the fund I wrote above. The fund. Either the loan amount, the fund, or the bond. It must be a loan. Why? Borrowing cost refers to cost and interest and other costs incurred as a result of borrowing. You can borrow from the bond market, you can borrow from banks. If you borrow from the bond market, the amount you earn is called a bond, or it can be a debenture, or you can borrow from the banks, which is a loan. All right. Number two, you need something which is called two. You must ensure there is an interest rate. interest or coupon rate. Interest for a loan, a coupon for a bond. It can even be debenture rate. 3, you will need what is called construction phase. Construction phase. Pay attention. When I start the calculation, I'll be citing all these things. So I've taken my time and I'm explaining them so that you can grasp them. Construction. Someone will be like, okay, me, I'm just writing it and I'm gone. It's a lie. You go and meet it again. Construction phase. Construction phase. All right. So it is PHASC. Construction phase, we'll be looking at when the project start time or start of the project. Let me use ST for start of the project, and what? The end of the project. When do you start the project? When do you end it? We need it. Number 4, we will need to ascertain whether or not the asset is a qualifying asset. If it's not a qualifying asset, we will not be able to compute the borrowing cost. So the asset must be a qualifying asset. What is a qualifying asset? A qualifying asset is an asset which takes substantial period of time to complete and make ready for use. A qualifying asset is an asset which takes substantial period of time to complete and make ready for use. Are we good? So, if it's a specific borrowing, what we need, even if it is a pool of funds borrowing, right? We need these items to be in place. So the borrowing cost is just, if it's a specific borrowing, the formula for the borrowing cost is just like you're computing simple interest. You did it in level 200. Also did it in, some of you did it in level 100. So what is the formula for computing simple interest? So borrowing costs equals the rate times the time apportionment, right, times the loan amount. That's it. So to which that is, let me say that is, as I'm using 12%, let's say it's 12%. It is 12% times, assuming the time here is a construction phase. The time here is a construction phase. What is the period of time we need to construct the project? Let's say we are going to use 6 over 12 months to construct the project. Times, what's the loan amount? Let's say the loan amount is 10 million. So this is the borrowing cost. When I find this, that will be my borrowing cost. When it's a specific borrowing, meaning the business is taking the loan or the bond from only one source. Class, are we good? Class, are we good?
Yes.
Yes, please.
Good. Let's continue. So pay attention. In this case, the borrowing cost period is 6 months. But mostly, when the business gives a loan, how many months does the interest cover? When a loan is granted a business, how many months does the loan cover? Yes. Mostly, you see, they would say the business, as part of the terms of the loan, they'll write 12% per annum, PA. Per annum means per year. How many months make a year? 12 months. Pay attention. 12 months. It represents that if the 12%, which I've used in the borrowing cost computation, is for 12 months, but the construction phase is 6 months, then it means that the borrowing cost is for only 6 months because the construction phase is for only 6 months. Then what will happen to the remaining 6 months? So if this is 12 months we are having here, out of this 12 months, 6 months is for the borrowing costs. 6 months is for the borrowing costs. Then we'll be left additional 12 months to make a single year. So if the first 6 months, which you have computed a rate on, is for 6 months, what will be the cost for the remaining 6 months? We will call the remaining 6 months finance costs. Finance costs. So if the borrowing cost is covering construction phase of a project, whether installation, whether a construction of a new facility, if the borrowing cost will cover 7 months, the finance cost will cover a moment. If the borrowing cost covers 6 months, the finance cost will take the remaining 6 months because it should be in total of 12 months. Therefore, if the borrowing cost should take 7 months, the finance cost will take 5 months. So that 7 plus 5 will give us the 12 up there. Now, follow. The treatment of this in the financial statement, I'm going to the next stage. I'm done with the measurement for the borrowing. I'm done with the measurement for the specific funding. But let me do the treatment together. So that by the time I take the question, we'll move quickly. 6 months is saying that how do we treat borrowing costs in the financial statement? So, borrowing costs, when we compute the borrowing costs, the figure for the borrowing costs, all right, is capitalized. It is capitalized. It is capitalized. Capitalization means that we add it to the cost of the assets. So the borrowing costs, which we computed, spanning the duration or spanning the specific phase of the project, right? Whether installation or construction of new facility or the purchase, right? Or let me say a specific operation on an equipment, that borrowing costs. So long as we borrow the money and commit the borrowing costs, it is capitalized. Meaning, if the asset cost is 200 cedis, if the cost of the assets, everything about that is 200 cedis, and then we found our borrowing cost to be 30, we'll add the 30 to the 200 to make it 230. So this will become the actual cost of the asset, not the 200. Why? Because we computed borrowing costs and we've added it to the cost of the assets. And cost of an asset, a non-current asset, is called capitalization. So now 230 becomes the actual cost of the assets. Class, are we good?
Yes, we are
Class,
good.
are we good? All right. Now, so when borrowing cost is capitalized, what will happen to finance cost? It is expensed. It is expensed. So in the financial statement, where do we record capitalized borrowing costs? We don't treat the borrowing cost separately, but it's added to the cost of the asset, and they all go to the non-current assets. Where do we find non-current assets? In the statement of financial position, which was called balance sheet. It is expensed. Where it is expensed, that it is added to. You see, in the financial statement, where we have the interest, right? We have profit before interest and tax. Then we have interest. That's interest. Another name you can give to the interest is called finance cost, because the whole borrowing cost, the whole 12 months was interest rate. The 12% for 12 months, that 12% is an interest rate. It's for the whole 12 months. And we have divided into two. A portion has been capitalized as borrowing costs. The remaining portion of the interest, that is what we record there in the publication accounts. Publication accounts, you have sales, cost of sales, you have gross profit, you take out operating expenses, you have operating profit, you add other income, then you're going to have profit before interest and tax. You take out interest, PBIT here, PBIT. Then you take out interest, you'll be left with PBT. So the interest is the finance cost, because finance cost is also an interest. Okay, right, let's move on. So it's expensed. When it's expense, what does it mean? It means take it to the P&L, profit or loss. So this is the treatment. Borrowing costs are capitalized mostly. With what you are going to do, you are capitalized. But sometimes we can also call this finance cost also borrowing costs, and it will be expensed. But you should not forget the reason why we are calling it borrowing cost, because it says what? Borrowing cost refers to interest and other costs. So finance costs can also be treated as what? Borrowing can also be called borrowing costs, and it can be expensed. So we have borrowing costs which you can capitalize, and borrowing costs we can expense. So that borrowing cost which you can expense, it is also called finance cost. That is cost on financing. What do we mean by cost of financing? Cost of raising finance for the business, the cost of capital. So cost of capital is the cost of finance or finance costs. Class, are we good? Are we good? Any questions?
Yes,
Let me pause for
please.
questions. Any questions? Let me pause for questions. All right. Pay attention. Now, this is all that we are going to do. Let me go up a bit. So I've talked about how to the treatment. The treatment is this area of the financial statement. This is how we treat it. This is the treatment or the presentation or the presentation. Okay, or the presentation. So this we present in the P&L. But when we get out, when we start solving out, just show you how we do it. It's simple. Okay, so that's it. Now, I was speaking on the specific borrowing, which is this. That's a specific borrowing. Now, pay attention. So the specific borrowing means the business borrow the source from only, so they borrow the money or the bond from only one source. But when it comes to the pool of funds represents that the business borrows from multiple sources. So the business can go for a loan from a bank. The business can go for a bond from the bond market. The business can go for another loan from another bank. So let's say this loan is from GCB. This other loan is from UBA. And it will go for bond. Don't forget, the loan from GCB will have its own unique interest rate. Let's say it borrow 10 million. They can give the business 10%. The bond can have a coupon rate of 8%. The bond can have a coupon rate of 8%. Then the UB also can also give a loan of 15% at a rate of 15%. So you could see, unlike the specific borrowing, where the business has only one source of financing, that is only one rate, with the pool of funds, look at the name, pool of funds, meaning the funds is in a pool, different sources mixed together. With a pool of funds, we need to find a single cost of capital. We have to find a single rate. And that rate, the name of that rate is called the weighted average cost of capital. Because the business is taking source of funding from different companies, from GCB alone, from UBA alone, and from the bond market, all together 3. And they all have different rates. The bond has a coupon rate of 8%, the loan has 10%, the UBA loan has 15%. So we have to put all together and find a common cost of capital, which is a common rate. So I told you that the 12% for the ABSA, the single specific borrowing, is called cost of capital or interest rate. It's the same. When it comes to the pool of funds, it's called WACC, weighted average cost of capital. So you're going to put all the interest rate for the 3 sources under the pool of funds with their corresponding or respective amounts borrowed, whether from the bond market or from the banks, and we'll find one interest rate. And that one interest rate is what we are going to use to compute the borrowing costs. Class, are we good? Are we good? Hello, are we good?
Yes, please.
the same way. So when we start to have the pool of funds, now, if it's a pool of funds, the number one will change to become what? The number one will change. We will need, number one will change, we will need the cost of the assets. Or, let me put it this way. Yeah, we will need the cost of the assets, the costs. We would also need the loan amounts, the loan or the amounts involved, whether it's bond or whatever. So I don't want to write loan because it might not be loan, it can be bonds or debentures. So we need an amount involved. Then we will need the interest or coupon rates. They not one because they are from different sources. Then we'll need a construction phase. The asset might also be a qualifying asset. So if it's a pool of funds, the steps become about 5. We will need a cost of the asset. How much is it going to cost the business to construct? Now, what are the amounts involved? Where the source of the funding, right? From the source of the respective or various sources of funding, what amounts are involved? We have to find for each of them. They have to find the what interest or coupon rates for each of them. They have to find the construction fee. They have to find the qualifying assets. If you get all these sets, you can start with your borrowing cost calculation. All right. Any questions? I'm going to move to page 2. Let me start from the top so I can see what we've done so far. Without the borrowing costs, IAS 23, we've defined it. We've spoken about the recognition measurement. I've done measurement. Now, presentation, I've done it for you to see. I'll leave out the recognition and then the disclosure. Disclosure is how you record it in the notes. Like the recognition criteria will be in the notes. The recognition criteria will be in the notes. How you tell people or tell the readers what it should be. So when you ask the recognition criteria, these are the 3. Then we have explain recognition, I've explained measurement. Then I've spoken about the bond loan funds you need. Specific borrowing, we need pool of funds. We need a single rate. The pool of funds is only a single source. So that one we go with 12%. One single rate. But if it's a pool of funds, we will need a WACC, a single rate to represent all the 3. And then if it's a specific borrowing, we need a brown numbers or the brown listed, right? We need a loan amount or bond. We need the interest or coupon rates, construction phase or qualifying asset. By the pool of funds, we need the cost of the asset. We need the amounts involved, whether borrowed or from the bond or from the banks. And we need the rates, right? And we also need a construction phase. And the asset must be a qualifying asset. All right. So that is it. Now I'm going to the next page. Let's bring a question so that we solve. Pay attention. It's not difficult, okay? It's not difficult. Just pay attention. Can you all see the screen? Hello, can you all see the screen?
It's not
Yes,
clear.
please.
Why can some see and others claim it's not clear?
It's clear now.
Okay, I hear. So I'll solve this. Then let's see. Let's start. All right. So I'm reading. Write any two criteria for capitalization of what? Borrowing costs. Who can tell me what the two criteria? Who can tell me two criteria? Someone should mention one. Another person will mention one. Raise your hand. Let me call you. Raise your hand. We've done it too. I told you we've done it. Yes, raise your
When
hand.
the expenditure is being paid.
Raise your hand. And she doesn't understand grammar. She doesn't understand grammar. She's not been to school before. She doesn't understand grammar. Raise your hand. She finds it difficult to raise her hand. Okay. When the expenditure is being incurred, yes, you can give me one. The other one. Hey, we did it together. Don't fail me. Cliff. Cliff, speak.
The second one is
Cliff, speak.
when borrowing cost is being incurred.
That's great. Who can tell me the third one? So let's say two. If the going says any two, it means that there are more than two. If the going says any two, it means there are more than two. So you can state any of the two, or any two out of the three or four. If in some they write that qualifying, there must be a qualifying asset. Some make it four. There must be a qualifying asset. Okay, so the third one, let me read the chat. Some people want to say something in the chat. Let me see what they are writing. When borrowing cost is being incurred, okay, that's fine. So we are done. You can read it. Now let's go to B. Kako Limited had the following loan liability. So where do you think they borrow the money from? Loan liability, where do they borrow the money from? Class, I'm asking a question. I want to see that you guys are following. Loan liability, where the company borrow the money from? Okay, let me say it myself. You borrowed it from banks. Banks give loans. And it's a liability because you have to pay back. Okay, let's continue. In place during 2024. So it had this loan liability, 24 million at 10% per annum, 16 million at 12% per annum. What type of funding is this under borrowing costs? Okay, before that, hold on. Before you start reading the B, come and read the requirement. What is the requirement saying? Calculate the weighted average cost of capital. In brackets, what? WACC. Calculate the borrowing cost to capitalize and the cost of the building plant at the end of the 2024 financial year. So you've seen WACC, you've seen cost of capital. You should know what's in the question. You should know your expectation. So first, before you start, come and read the requirement. You should know your expectations in the question. How much should be recognized as finance costs? You should know what finance cost is in the P&L accounts. So finance costs, P&L. P&L is how do you present it? What is the presentation of the cost in the financial statement? I good. So before you start, come and read the requirement. When you read the requirement, then you put the question knowing what your expectations are in the question. Class, are you good? Always read the requirements first. If you read the requirement, then you know what the case study is talking. Your expectations in the case study will be. Are you good? Or are. So when you put the question, you know what you are going through. So now you see that it says calculate the weighted average cost of capital. Now I said, so what? Calculate the borrowing cost to capitalize. Watch. It's a standard. So everyone who is doing financial reporting should be able to understand the standard. Watch. So now, having noticed the requirement, what is the name? What type of funding is this under borrowing costs? We did it today. Just not 7 years ago, just some minutes ago. Raise your hand, I'll call you. What type of funding is that? Raise your hand, I'll call you. Raise your hand, so I'll call you. Yes, raise your hand. Hey, you don't know what type of funding it is? Annabelle, Brenda, Erica, Gabby, Irama, Naima, Laurentia. Because I mentioned people in the sample are running out from the class. Ruthie, me, Nanaya, Hey, today my class is full of ladies. What are the guys? Yes, those whose names I've mentioned. Anyone should. Cliff, you hold on, Cliff, hold on. Let me see whether the others can get it. What type of funding is that thing? Is that for those two figures? What type of funding is that? Borrowing cost. Because I mentioned somebody's name, he has left the group. I'll not say anything. Brenda.
Please, pool of funds.
Good, full of funds. Because it's talking about the weighted average. So you should know that this is called the pool of funds. We've dealt with it. If it were only one source, that would become specific borrowing. So pool of funds, we dealt with it. It says the company installed a new bottling plant costing this amount in 2024. The project of which was financed from the pool of funds is been stated here for you. The project commenced in the first week of January 2024 and was completed 30th September. Payment to the contractor were scheduled as follows: 10 million, 1st April 2024, 40 million, 30 September 2024, 2 million. Are you getting it? The plant was commissioned and put to use in 1st November 2024. Required, calculate the weighted average cost of capital. In some questions, they could just say, calculate the borrowing cost to capitalize. And they would add the three marks and make it 6 marks. Right? They could add the 3 marks to the 3 marks, make it 6 marks straight. So you must know that if you say you carry the borrowing cost to capitalize and the funding is about pool of funds, then you should know that pool of funds, you must find a single rate. So let's start solve it. So I'm keeping it on the right. Whenever I need it, I'll bring it up. Or let me keep it at the top. So whenever I need it, I'll call for it. Okay. So we start. We said we should calculate the borrowing cost. I'll bring another question on this. So today, most people said borrowing cost is their difficult standard. That is quite confusing sometimes. So I understand them. IAS 16, IAS 40, those ones, they are easier. Okay, IAS 16, IAS 40. So the WACC. There are 2 ways I can solve the WACC, but I'll just teach you one. So WACC will be equal to, what did we say we need when computing borrowing costs? What did we say must be present? What do we say are elements to be available or present before we can start computing borrowing costs? Who can tell me some? We just did it too, not 7 years ago, just about 5-8 minutes ago. Oh, what element must be present for us to be able to compute borrowing costs? We did it. Raise your hand. Raise your hand. Okay, Irama. Irama. Irama, she has muted herself. Irama, yes, you raise your hand. Wow. Okay, whoever can want to say something, let me write it. 1, we said that there must be a qualifying asset. So long as the question is asking us to compute the borrowing cost, it means that the asset being to be constructed, to be installed, which is New bottom plant is a qualifying asset. So there's a qualifying asset. What else? There must be interest rates. We have 10%, we have 12%, right? Interest rates, they are there. Okay. We also have, there must be square loan amount of bond values. They are all there. We have 24 million, 16 million, they are there. We also have the construction phase. We also have the construction phase. What is the construction phase? It is from January, right? It's from January to where? September. That's when the project will take place. So we have the construction phase, we have the interest rates, we have the amounts, we have the qualifying assets. So it means that we can quickly compute our borrowing costs straight on. So let's start. It says you calculate the WACC. So the WACC, what do we need? We need the amount and the rates. So let's go down. So WACC equals, we have the first amount to be what? 24 mil. I'll not write all the mil. I'll only use 1,000 times, what is the rate for the 24,000? That's 24 million. It's 10%. So let me write it properly. So equals 24 million times 10% plus, let's go and see the other one, 16 million times 12%. 16 million. So I'm just writing 3 zeros. 1, 2, 3 times what? 12%. All divided by, I'll add this to this. What does it give me? 40, right? 40,000 or 40 million. I'm using 3 zeros, so let me use 3 zeros here. What will be the final figure? So the 40 million is the loan amount, which I added together. Yes, what will be the final figure? So on your calculator, you just compute everything together on your calculator. Yes. If you can't see the question to be sent to the group, wait. You want to finish, I'll drop it there. When I finish, I'll drop it there. The question, if you just joined, there's a question. We are solving the question 2. So this is the question. We have gone through the question already. We have gone through the question already. So we are just solving the requirements. We are attending to the requirements now. So maybe you joined late. So, but this is the question we are solving. So what's the figure? Oh, be quick. I don't want to spend so much time on this. Today I'm doing only borrowing costs. Then tomorrow or whatever, I'll take another standard. I've looked at all of your examinable areas. So I'll pick another standard. If it's IFRS 5, then we'll deal with it. If it is IAS 40, we deal with it. If it is IAS 2, we deal with it. Then I'll see how to help you guys. Oh, what's the value? Somebody has written in the group chat. So let me check.
0.108. 108.
Okay. All right, Nee, thanks. So 0.108. 0.108. Now, this is in decimal fraction. WACC is measured in percentage. So I'll just multiply by what? 100%. Your man accounts, it was very, very, very easy. Very, very, very easy. So these people, they want you to pass. That's why. Some years ago, they'll make it only 4 questions. You choose 3. The way you be hot. They don't want you to fail. That's why. That time, they'll give you about 20 questions. 20 or 25 tutorial questions. So many. You don't even know what to do to, which questions will feature. Plenty. Okay, they want you to pass, so they've made it very light for you. Even with this easy questions, people will fail. Sometimes we don't even know what they want in life. With these easy questions, people will fail. So this is the WACC. So the WACC is this is a common rate to represent the combination of the two rates, the weighted average cost of capital. 12% is the cost of capital, 10% is the cost of capital. When we weighted them against the weight is the 40,000, which is the combination of what? The 24,000 and the 16,000, which gives us the 40,000. This is the weight. Let's move on. Any question before I'm going? I'll share the question in the group. So this one is only on IAS 23. After that, I'll take another question. All right, let's continue. We have what? The next question says, calculate the borrowing cost to capitalize. Calculate the borrowing cost to capitalize. And the costs of the bottling plant at the end of what? 2024. Okay. Watch. So now we'll move on to the next thing. For us to calculate the borrowing costs, there are 2 methods I can use here, but I'll use one. Then I'll bring a question which requires the second method. Then I'll solve it with you. Then I'll finish. That one, the only difference is that there is a little, just a sentence which makes it different from this, but it could be the same approach. But that part will make it different. So pay attention. So now here it says that we've known the construction phase, right? The construction phase is from January. It's from January to September of the same year. So how many months? January to September gives us how many months? 9 months. There's the construction phase. We are now computing the borrowing cost. So we need a construction phase. But it says that the payment to the contractor was held as follows. On 1st January, they will pay the contractor 10 million. Don't forget, the total cost of the construction, the total cost of installing the plant is how much? Currently is how much? 26 million. When I add this, they should give me 27. This is up here. The 26 is up here. Are we good? Are we good? But,
Yes, please.
But they wouldn't pay the 26 upfront. They wouldn't pay the 26 upfront. They will pay it in tranches. Tranches mean they'll pay it in pieces or in bits. So they will first give the contractor on 1st January 10 million. He will be left with 60 million. And on 1st April, they will pay additional 40 million. And on 30th September, they will pay the balance of 2 million. Are you good? All right. Now, the plant was commissioned and put to use in 1st November 2024. We are not interested in when they put it into use. We are interested in when they completed it, because immediately the project is completed, right? Borrowing costs will end. Borrowing cost ends when the project is completed and then delivered to the management. I get it. So immediately the project ends, management takes over. They will start computing depreciation. But the construction phase is the period in which the project would take place. So when we are interested in the construction, when they will commission it, that one is up to them. Because immediately the borrowing cost period ends, the construction period comes to an end, right? That is when the construction is completion. Then depreciation will start being computed. So we have the cessation of borrowing costs and we have the suspension of borrowing costs. Borrowing costs will be suspended when some activities beyond the control of management, right, takes place. For example, when COVID came in, borrowing costs will have to be suspended. But then immediately the COVID went, then immediately the COVID went, and then immediately the COVID went away, and then construction resumed, borrowing costs will also be resumed. And we have cessation of borrowing costs. Borrowing costs will be ceased when the project is ended, or when completion, or when the construction of the assets comes to a halt or comes to an end. Then we'll see the borrowing cost computation. All right. So now, from what we are saying here, they didn't pay the 26 million straight on. They paid in tranches. So we are also going to compute our borrowing costs. Let's go down. Pay attention. II. Borrowing costs, right? Borrowing costs. So one, what do we need to estimate the borrowing costs? We need a rate, right? What do we need? We need a construction phase. Construction phase. Here, the construction phase, all the start. Start is 1st January 2024. And end. The end is when? Is it 30th or 29th September of the same year, 2024? So together, how many months? 9 months. That's the construction fee. We need it. So we need a rate. What is the rate? The rate here will become our WACC. What is the WACC? 10.8%. 10.8%. 10.8%. So we need a construction phase. Now, what else do we need? So we need a rate, we need a construction phase, we need the amount. Here, we are not going to use the loan amount, we're going to use the costs. All right, good. We are going to use the costs. Or, yeah, let's say the costs. Then here, what else do we need? We will need, is there a qualifying asset? Yes, it is. We need a qualifying asset. In exam, don't write all these, just go straight away and compute it. But because I'm teaching, I have to break it down for you guys to understand. So now let's compute the borrowing costs. But before that, the amount wasn't paid straight away. Assuming they said the cost was paid upfront, or the 26 million was paid upfront. This is how the borrowing cost will be computed. I'd have computed it this way. Borrowing cost equals the simple interest formula. But here I'm going to use the WACC. What is the WACC? 10.8% times how many months? What's the construction phase? 9/12 times what? 26 million. 26. 1, 2, 3. 1, 2, 3. So assuming the question had said they paid this amount of money to the contractor upfront, this will be my borrowing cost to be computed. But I'm going to use the WACC as the single interest rate. Then the construction phase, which is the time period, and then the loan amount, the cost of the assets. But here, that is not what they are saying. Here, the amount wasn't paid straight on. How was the amount paid? The amount was paid in tranches. So we also have to compute the borrowing cost in tranches. So now, let's start. Here, right? When was the first payment made? 1st January 2024. As the project end, September, that is 30th or something September. Let me write it this way. So 1st January 2024 to 30th September 2024. I good. How many months is that? 9 months. We calculate cost as the rate, which is 10.8%, times, right, 9/12 times amount paid. How much paid to the contractor in January? So 10 million. here. 1, 2, 3. 1, 2, 3. 10 million. What will be the figure? What will be the figure? Quick. What will be the figure? Hello?
$810,000.
810,000 cedis. Now we come. Another borrowing cost. We will now the first month of 1st January to 30th September. Let me go up. It was from 1st January to 30th September, which was 9 months. So I'm using blue. Watch. So from 1st January to 30th September, we had 9 months. Then from 1st April to September, how many months would that be? How many months would that be?
6 months.
6 months.
Good. 6 months. So we're going to compute the borrowing cost on 6 months. From 1st April to 30th September. So borrowing costs, 1st April 24 to 30th September 24. There's another method, but let's stick to this one. Right? How many months is that? 6. Six months. And here we had 9 months. So 6 months, we go with the same formula. 10.8, which is the rate, times here, not 9, rather 6/12, times how much was paid to the contractor? 14 million. Times 14 million. One, two, three. 1, 2. Yes, what's the final figure?
756,000 cedis.
756,000.
There's it. So we go up. Total borrowing cost. Total borrowing costs equals $810,000 plus 756. What do you have in total? Mm-hmm.
1,566,000.
566,000.
All right. So this is your borrowing cost. This is the borrowing cost to capitalize. There's another method, but let's hold on. Then he's saying that when upon finishing, we are on this B. Calculate the borrowing cost to capital and the cost of the bottling plant 2024. So now we are going to compute the cost. So cost of bottling plant. So costs of bottling will be to the 26 million, which is the cost of the assets, plus the borrowing cost to capitalize, 1,566,000. In total, we are going to have 27,566,000. This is the borrowing cost. This will be the actual cost of the assets. Are you good? Are we good?
Yes, sir. Yes.
All right, let's go to the next question. Ruthie and Ate, thanks for the information group. Let's check next question. The next question says, how much should be recognized as finance costs in the profit loss accounts? So that's the treatment. So before that, let me show you something. Assuming the question says, show how they should be treated in the financial statements. If it's the bottling plant, you write it this way. In which of the financial statement do we recognize of bottling plant? Did it? Who can? Hey, class, don't disgrace me. We've done the theory, yes. Who can tell me? What you are doing is called measurement. What you are doing is called a measurement. You are cutting it. Yes. So in what? Okay, we said the cost of the assets are recorded in the statement of financial position. So statement of financial position extract is an extract because we're doing it only a small portion of the entire statement. The treatment, how to treat it. And I write here non-current assets. Underline. I'll put here Ghana's this. Can put razors at it here. Here, bottling plants. Yeah, bottling plant. So bottling plant, right? So bottling plant. How much is it? 27.5 a line. That's it. That's how it is in the financial statement, the presentation. The bottling plant is an asset. The cost of the asset, this is how you're going to treat it in there. Okay, let's see this. Borrowing cost to be expensed. They said the borrowing cost to be treated in the financial profit or which is the finance cost. I've told you that they can say borrowing cost and they can say finance cost. You should know what that means. So C. Cost the expense. Let me say finance or borrowing costs. So when it goes to the other, they change the term, not be confused. Finance or borrowing costs. To be expensed. Now, to be expensed means to be in the P&L, to be expensed.
Sir, please, I think your board
So
has
now
died.
it has frozen.
Yes, please. Your writing is not showing, just your voice.
Oh no. Who? No. If you can't see it, then you look and join because others can see it.
It's not
Are you
moving
good?
here either.
Hey, who else can see the board?
Me too.
Who else can see my screen? Let me see your hand up. If you can't see my screen, let me see your hand up.
Okay, I think it's able to move now.
Maybe sometimes the network from your end.
Yeah. So the whole of C,
Currently
for the whole of
36,000
C, we didn't see you
right
write
now.
anything.
It's a scam now.
So finance or borrowing costs to be expense. Let's move on. Now, here, you remember I was explaining that if it is not, if it's 9 months, you calculate the remaining specific, but with the pool of funds method, as you would be wrong, right? The pool of funds, sorry, you would go and find the interest on each of the loans. I good here, here, here. So here, this is where you can calculate finance cost because you find it on this, then you add. I get it. You take out the borrows from it. So you're going to use this. So we have 24 million is 10%, 16 million is what? 12%. Okay. Finance or borrowing costs to be expensed. We would say 10%. Let me put Ghana City here. Let's 1, 2, 3. So 10% on, right? What's the first figure? Is it 24 million? The next one is what? 12% on 16 million. So 10% on 24 million will give us 240,000, right?
Yes.
Or 2.4.
240.
Is it 2.4?
No, it's 240.
240,000.
Yes.
All right. Guys, you guys confirm for me, okay? So I don't make mistakes.
No, it's 2.4.
No, 2.4. Good,
Yes.
it's 2.4. If you say 10, if you say 2.240, then it is 1%. So it should be 2.4. Then 20. What should give us? %. How much will it give us? Guys, quick. 12% times 16 million.
$1,920,000.
1,920,000.
920. I will add. I'm going to have here to be 0, 2, right? 0, 2. This will be 3, and this will be all 3, 4. So this is the borrowing cost. This is the finance cost. But then look at something before I continue. Look at something here. Look at something. If I have the total interest, so this figure here is the total interest And this is per annum. This is per annum. It is times 12. It is times 12 over 12. Full year times 12. 12. This is full year. So the whole year. I explained to you before. It is 12 months. Borrowing cost takes 8 months. The remaining month goes where? Finance cost. So let me write an equation for it so I can see. So full year interest rates, interest IR for interest rates for the full year is equal to the what? Borrowing cost plus what? Finance costs. Do you guys get it? Watch. The full year interest rates, like the 12 months, is equal to what? The borrowing cost rate plus the what? Finance cost rate. And I told you that assuming borrowing cost is 9 months, how many months should we add to 9 to make it 12? We have to add 3, right? 3 months. So this 3 months is for the finance cost. This is for the borrowing cost. Or assuming we have 9 months for the borrowing costs, and we don't know, we have 9 months for the borrowing costs, and we don't know the remaining months for the finance costs. Let's assume that the finance cost is X, and the interest rate is 12. What do? We just make the finance cost the subject by saying, okay, if you want to know the remaining months, if borrowing cost us 9 months, then we're going to say 12, right? We're going to say 12. Then we just say 12 minus 9 equals X. So I can X towards 3. That's what I'm trying to do here. That's what I'm trying to do here. So the 10% times for the whole month, for the whole year, 12% for the whole year. This is the total interest. The 4321 is the total interest for the year, for the whole 12 months. So interest for the year. Interest for the year. Interest for the year, 12 months. Then we will less the borrowing cost. Less borrowing cost to capitalize. Less borrowing cost to capitalize. What's the borrowing cost to capitalize? Let's go up. What borrowing costs do we have? 1 million. This figure. I'm using. We have 1,566,000 is the borrowing cost to capitalize. We come down. We're going to less it from what below. So we have 1,566,000, right? We less it. We're going to have here to be 10,4, here to be 11,5, here to be 12,7, here to be 2. Is that correct? Is that correct? Is that correct?
Sir, please, your board has frozen again.
It's your screen or it's your network? Because for mine, it's working well. So let me
Yes,
wait.
it's correct.
It's not only his. Me
All
too,
right.
mine is the same.
Then maybe it's your network. It's your network. That should be okay. But when I finish, I would upload a video. So you can just go and check it. Where you didn't get it right, you just go over it. Okay. So this 2754 is the finance cost to what? Expense. Borrowing cost to capitalize. Finance cost to expense. Don't forget, this figure is in millions. So why is it in millions? I've kept the 3 zeros at the top. I found 3 zeros here. I found 3 zeros at the top. So this is in millions. I found 3 zeros here. Are we good? Are we good? and it follows this order. Yellow, using yellow. I follow this order. The interest 12 months. And from the spread, I told you that we have to add the borrowing cost and the finance cost to get the total interest for the year. So if the interest is 12 months and borrowing cost is taking 9 months, how do we find finance cost? We have to find the total months for the whole year, which is 12 months. Then now that we've known that borrowing cost is 9 months, we go and take borrowing costs. We go and take borrowing costs. I'm using yellow. We go and take the borrowing costs, right? From the total interest for the year. We take the 9 from the 12 below here. Then the difference will give us the finance cost. So that when we add the finance costs and costs, they both will give us 12. So I'm going to have 12 is equal to 9 plus 3. So when I add this finance cost to expense and the borrowing cost realized, they should all give me the interest for the year. We have finished the first question. Class good? Are you all good? Are we all good?
The board is white. We are not seeing anything.
If you can't see, you just leave and rejoin. Because I'm still teaching. I can see writing and people can see. So if you cannot see me, it's network. So you have to leave the session and rejoin. You see it. But don't worry, when I finish, I will share it on the channel and go and watch it at your own time. So I'm giving you some time to go through and write whatever you want to write. Have you written down or you've not yet written anything? Down. Hello, have you written information? So go through your notes. Have any questions? Let me know. Ruthie, which last part should I go? Tell me where is Ali, because the last part, there are many. Yes, Ruthie, where do I go through? Ruthie can't speak, but she can write. You are ready for you. The C. So the C, I said, just let me take it from the bottom. We must first find the whole year, the rate for the entire year. Don't forget I told you that the interest rate, the first example I gave you, the interest rate was 12%, and it was for the whole year, for the 12 months. And the 12 months, from the example I gave, 9 months, 6 months was for borrowing costs, and the remaining 6 months will be for finance costs. So this example, 12 months is for the IR, the one I've just circled, the IR represents interest rate, and it's for 12 months. And the 12 months, we have the borrowing cost plus the finance cost. So if we are calculating for 12 months, and we are saying that probably the borrowing cost is 9 months, are you getting it? When I take the 9 months out of the 12 months, I'll find the finance cost. It doesn't mean that the values I'm using here, are 12 months and 9 months values. No. Yes, they are 12 months and 9 months. Because from the calculation I gave, for the finance or borrowing cost to be expensed, I made it 10, we made it 10% times the 24 million, the loan. We are dealing with the loan here. We are dealing with the loan amount. We are dealing with the loan amount. So 10% times 12, right? 10% times 12. 10% times 12 times 24 million. 10% times 24 million times 12 over 12, which is 2.4 million. Then 12% times 60 million times 12 over 12. Because I'm calculating the interest for the whole year. That's the 12 months. So we got 4,320,000, which is the interest for the year. Which is the interest. Then we came in to find we less the borrowing costs. That is what I was trying to explain here. At the bottom over here, right? I'm using green here. That we have 12 months. Then if the borrowing cost is for 9 months, and for us to find the finance cost, we have to deduct the borrowing cost from the entire year, 12 months, to get the difference, which is the finance cost. So if that is the concept, then we will say that if the interest for the entire year is 432, I'm using green, 432 million. If the interest for the entire year, right, is 432.2 million, right? Then what is our borrowing cost? Our borrowing cost, green, is 1,566,000. I found 3 zeros at the top. I suspended 3 zeros. The difference will give us the finance cost to expense. The same concept. If the entire month, and the borrowing cost is for 9 months, don't forget. The borrowing cost is for only 9 months, don't forget. And the entire interest for the year is for 12 months. So how many months make up the finance cost? 3 months. So simply, if you know the total interest for the year, right, then we know the borrowing costs. Because the borrowing costs added to the finance cost give us the total interest for the year. Then to find the finance costs, whereas we know the total interest for the year and the borrowing costs, we will just make change of subject and make finance cost the subject. Then go and subtract borrowing costs from the interest for the year. The remaining or the difference will become the finance cost. Class, are we good? Class, are we good?
Yes, please.
Yes, please.
All right, that's good. So I'm bringing another question. That will be my last question on borrowing cost. So you now, anywhere they will throw the borrowing cost question, you'll be able to get it. It's not difficult. It's a matter of understanding. If you understand the concept, even if you don't get it right, okay, if you don't get it right, you can score your B plus, which is good. It's not really bad if you score a B plus. My teaching appointments are many, so I can't have time teaching all the time. My teaching schedules are so tight. So let me show you how we can expense the finance costs. Exams, you can be asked to show the treatment. So let me show you how you can expense it. I've shown you how you can treat the assets. So let's go. Here you write the finance cost. You write P&L extract. It's an extract because we only deal with a small portion of the entire P&L. So you say an extract. So we go. Ghana cedis. Let me put here 3 zeros. One, two, three. You just write finance cost. How much is it? How much was it? 2,754. 2,000. $2,754. Then you double underline. That's all. That's an extract. So you just do it this way. That's all. That's the end. We good? We good?
Yes.
Sir.
All right, so we are done. I'm bringing another question. Hold on, let me get the question. So welcome, guys. This is the next question. It is similar. The difference not so great. The difference not so great. Okay, but it's the same concept. All right, so who will read for us? I want someone to read for us. Can you all see my screen? Can you all see it? Can you all see the question? Can you all see the question? Can you all see the question? Hello?
Yes,
Hey,
please. We
class.
can.
Okay, that's fine. Who will read for us? Someone should read for us. Hey, you can't read, right? Need read for me. Need read for us. Yes, need read. Okay, let me read. No, I want somebody to. I have a reason for saying that. Some people are moving.
I wish I can, but the image is very blurry.
Who is that? Is it Brenda? Brenda, is it okay?
Please, it wasn't me who spoke.
Who
Yeah, I
did?
think this is.
Hey,
I
I
was
see a guy's
Richard.
name. I see
Yeah,
a
it's a
guy's
guy.
name.
Don't mind the ball.
Hey, Bema. Mate, read. You read for. I don't say anything. You
So please,
read.
I can't
I
see
Bema, read.
the.
can't really see. So
I can't see the
If you
image well.
hold on. Oh, I've zoomed it out. Isn't it okay, or it's too small?
I still can't see it.
okay.
Hold
Oh,
on,
it's
hold on.
too much. Okay, this is fine.
Guys, can you all see the screen?
Yeah.
Hello, can you all see the screen? This is our last question. This
Yes,
one,
we
there's.
can see.
All right, great. So read.
Okay. Wala Limited began the construction of a new office
You are wrong.
complex.
I told you. Hold on. I told you how you should approach the question. I don't know if you were in the class. Who remember what I said
Okay.
before you start?
Read the requirements first.
Very good. Very good. So go to the requirements.
Okay. Determine the borrowing cost to be capitalized and the capitalized cost of the office complex. II. How much borrowing cost should be expensed? C.
Okay. So you could see it's similar to the one we solved, right? Are you getting it?
Yes, please.
It's similar to the one. So how much you see here? They didn't say how much finance cost. What did they say? How much borrowing costs? They didn't say. The question didn't say that how much finance cost should be expended. They said borrowing costs. So I told you the terms can be used interchangeably. All that you have to take note is that you understand the concepts. That's all. Then you'll be gone. Okay. So the question says what? How much borrowing costs? Because other interests are also term borrowing costs. How much borrowing cost should be expense? So it's referring to the finance costs. Okay. So it's talking about determining the borrowing cost to be capitalized and the capitalized cost of the office complex. So you find the borrowing cost, you add the cost of the office complex, then you treat them in the financial statement. This whole thing, 7 marks, meaning it's not so much of a work. All right, so now let's go to the top. Read.
Okay. WALA Limited began the construction of a new office complex on 1st January 2022 and was completed on 31st December 2023. The building cost the company 15 million Ghana cedis. However, to allow itself some margin of safety, WALA Limited acquired a loan of 20 million from 3 different banks as follows. GCB Bank, 7 million Ghana cedis at an interest rate of 12% per annum. Cow Bank, 8 million Ghana cedis at a rate of 15% per annum. And ADB at 5 million Ghana cedis at a rate of 22%. Out of the 15 million Ghana cedis allocated to the project, 5 million was not immediately needed. As such, it was put in a short-term investment till 30th June 2023, which yielded an interest income of 10%. During the period of construction, the salaries of the laborers were delayed, and this led to strike action by the laborers, which lasted for 2 months.
All right, so let's see what we can do. Okay, so you see, during the period of construction, the salaries of the laborers were delayed, and this led to a strike action by the laborers, which lasted for what? 2 months. Okay, during the period of the salaries of the laborers were delayed, and this led to a strike action by the laborers, which lasted for 2 months. Okay, so let's see what we can do. So what comes to mind? Yes, what comes to mind?
Please, what comes to mind? Are you relating it to the strike action?
No, they are solving the question. They are calculating the borrowing cost.
Pool
Okay.
of
So
funds.
first, good. Pool of funds comes to here. What else? A. What else? Quick. What else? Oh,
Please, can I say the WACC?
come again.
Can I say the weighted average cost of capital?
Yeah. That also comes to mind. That's correct. What else? Now you have to be weighing all the possible outcomes before you start the solution. So the first one we did, they give us the year, so we're able to compare. But here they didn't give us when they paid what. They just said the bank went for a loan from 3 different banks. Pool of funds comes in. So if pool of funds, what comes in? WACC comes in, right? It is there. You also look at the cost of the asset. It's 15 million. Out of the 15 million allocated to the project, 5 million was not immediately needed. So what did they do? They invested 5 million. It is called investment income. Investment income. We're going to invest this 5 million. As such, it was put in a short-term investment until 30th June 2023. So from when? From 1st January 2022. Is it from 1st January 2022? To when? 30th June 2023. How many months did they invest it? You have to calculate it. Which yield at a rate of what? 10%. So I told you that the difference and this one is a different approach of the borrowing cost. During the period of the construction, right, the salaries of the laborers were delayed. And this led to a strike action by the laborers, which lasted for 2 months. So we talked about suspension of borrowing costs. That when certain actions take place which are beyond the control of the management, borrowing costs will be suspended, because at that time there's been a pause. There's been a stoppage of the operations. So if laborers who are working stop working, will the work continue? If the laborers cease to work because they are on strike action, will the work continue? Guys,
No,
let's be
please.
No,
quick.
please.
Good. So at that period of 2 months, borrowing costs will be suspended. And after the 2 months, so now we have to find the construction phase. The construction phase of the project, how many months were they? So the construction phase, let me use CP for the construction phase. This is too bold. Construction phase, let me use CP. Construction phase. When did it start? 1st January 2022. And when did it end? It completed on 31st December. When? 2023. So how many months?
24 months.
24 months. So we'll make it, when you are computing, we'll make it this way. 24/12. I get it. That'll be the construction phase. If you are computing the time, it is called time apportionment. We'll make it 24/12. And mostly, you make the reports on 31st December 2023 because that is the latest year. Are you getting it? So if you are the ability to prepare the reports, the financial statement will be the financial statement for 31st December 2023. So we make it 24/12 months. Then we would apportion it, then we would strike it out. But here, 2 months were seized. So 24/12 minus 2, there's another way, which will give us what? 22/12. So the borrowing cost will cover 22/12 because there were 2 months where there was a cessation. I don't know if I'm making sense. Am I making sense? Hello, am I making sense?
Yes, sir.
Whenever there is an action which goes beyond the control of management, borrowing costs ceased. Ceasing means that, sorry, it can be suspended, meaning we are not going to compute the borrowing cost for that period. But immediately the construction resumes because the 3 criteria must be effective, must be in play before we can compute borrowing costs. What are the 3 criteria? 1, expenditure on the asset is being incurred. 2, borrowing cost is being incurred. And 3, activities necessary to bring the asset into its useful place are in progress. So, in other words, construction is ongoing. So, if construction is not ongoing, laborers have ceased working. The business may cease to buy additional items for the laborers to work with. So, those 2 months, if the 3 criteria, 1 is omitted, it means that you cease borrowing costs. You cease computing borrowing costs. If the 3 criteria, 1 is not present, right, it means that I cannot compute borrowing costs. So here, assuming they were still spending money and borrowing costs were still being incurred, but the activities necessary to bring the asset into useful place were not in progress. That is, employees or laborers were not working. You cease computing borrowing costs unless all the 3 are invoked, all the 3 are in action. Then you can start computing borrowing costs. So immediately 1 is out, it will be taken out. Are you getting it? So that is it. So yeah, we're going to use 22/12. Because 2 months were idle months. Idle months, because so that those months, borrowing costs will be suspended. So I'm going to 22/12. So now let's start with the computation. Let's see how it goes so that I finish. And then there was an interest income. So this 5 million thing we've gotten here, this 5 million value we've gotten here, 5 million value. What we'll do is that we're going to invest it. So it can be, how many months did they invest it? From 1st January to 30th June. So we are going to say that investment, we're going to say 5 million times 1st January to December is 12 months. Then plus 6 months, so 18 months. So 18/12 times, what is the rate? 10%. This is the income, investment income. This figure is the investment income. Then when we get the investment income, we will come and subtract it from the borrowing costs to get the borrowing costs to be capitalized. That's a different one I wanted to teach you. Whenever there's an interest income, investment income, and there is a borrowing cost, we invest a portion of the cost, the money. Then when we get income, we come and subtract it from the borrowing cost to be capital for the borrowing cost, for us to get the actual borrowing cost to be capitalized. Are we okay?
Yes.
Okay, so let's finish it. After that, I'll upload a video on the YouTube channel and I'll share it. Then you can take time and revise it. So let me clean all this. That's how you study. You have to first go to the requirements, read it, then the requirement will tell you what to do. Then you start with the approach. So let's go. Solution. All right. So let's calculate the WACC. You know, the question didn't tell us to find the WACC, but you should know. The question didn't tell us to find the WACC, right? The question didn't ask us to find the WACC. But you should know that so long as there's a pool of funds, you have to find a WACC. So WACC equals, let me go for the values. 7 million has what percentage? 12. 8 million has 15. 7, 12, 8, 15, 5, 22. 7, 12. So 7, 12, 8, 15, 5, 22. So what do we do next? Watch black. You add the 7 million to 8 million to 5 million. That become the weighted, the average, the weight of the average. So 7 plus 8. 7 plus 8 will give us 15 plus 5, 20 million. So divided by 20 million. So what do we have? What do we have? Well, on your calculator, don't bring the millions. Just make it 7 times 12 times 8 times 7 times 12, bracket close, plus bracket 8 times 15%. Sorry, into bracket 7 times 12%, bracket close, plus bracket 8 times 15%, bracket close, plus 5 times 22, bracket close, all over 20. Don't bring the million because all the million they'll cancel each other.
0.157.
Okay, Ruthie is very sharp. And this guy to 0.15. It says I shouldn't mind your voice. Bema, I'll mind your voice. It's a cost of capital, so we make it times 100%. We should give us what? 15.7%. That is our WACC. The question didn't ask us to find WACC, but you should know that you have to find the WACC because it's a pool of funds. Then we proceed. Borrowing costs. Now what the situation is that it's not like the first one where there were divisions of payment or payment in tranches, or there was a payment plan. Here it is straightforward the cost. So borrowing cost will be equal to the 15.57% times, I good, times, we can go with the entire 15 million, then minus 5 million, Are you getting it? Times, yes, how many months? 24 minus 2 over 12. Are you good? Or we can say, okay, let me use another method. So what's the duration? What's the duration for which they invested, the investment income was? What the duration for which the investment income was?
18 months.
18 months. So we can make this one 18 months here. We can also work out. So 18 over 12. That was when there was no 5 million. Are you good? So what do we have? Yes, what do we have? Or another method, let me take this out. Let me make it full year. Let me just go straight. So 15 million, right? Yeah, I can also make it full year. Or 15 million minus the 5 million, right? Then times 18 over 12. Mm-hmm. Then after that, I'll add the other part. Let's go back. So what do we have? Let's be quick. What is 2.335? Okay. So 2.355. So 2.355 million. I good. 2.355 million. Then we can say, or another method, we can go by the entire 5 million. We should be getting the same figures. We can go by the entire 15 million. I good. We can go by the entire 15 million. Let me use that method also and see. Times the 24. So let me go by this 24. That will give me a straight figure, and that one will be easier. So 24 minus 2, because they were suspended for 2 months, over 12. So what do we have for this? Mm-hmm. Oh, let's be quick. 4. Ruthie David Rama, thank you. 4.3175. So 4. 3,175. Then I'll come investment income. This is easier. Let me take this method. The first one, it will make some people. So investment income. How much did they invest? 5 million. At what rate? 10%. For how many months? 18/12. What does it give us? Yes, what does it give us? $0.75. So I'm going to have it to be 0.75. Now we will less the investment income from the borrowing costs, the general or initial borrowing cost. What do we have? Yeah, when we less, what do we have? 4.3175 minus 0.75. $3.567.
Yeah.
So 3.575 million. Mostly you have to make it 4 decimal places, which is correct. 3.5675 million. $3.575 million, right? This is the borrowing cost to be capitalized. Now, after you've gotten this, the question says what? What's the question saying? It says, determine the borrowing cost to be capitalized and the capitalized cost of the office complex. So what was the cost of the office complex? 15 million, right? 15 million was the cost. So we'll come here and we'll come with cost of office complex. There will be 15 million. We add going to be 18 18.5675 million. This is the cost. So this is the cost of the actual cost of the assets. Or actual cost of the office complex, capitalized. Are you good? The first one would have led it to be very, very long. So this is how you're going to have it. 3 million. Now it says the finance cost to be what? So that one, let me explain. It's like the previous one. The finance cost, the borrowing cost to be expensed. This is the borrowing cost to be capitalized. Then we have the borrowing cost to be expensed. It says II. How much borrowing cost should be expensed? It's simple. Just like what we did initially. You find the interest on this. Let me do it right here so I see it. So what is the interest? 12% on 7 million. How much do we have? Don't add a million. Just make it 12% on 7. How much do we have? Now this is, remember this is 12 over 12 per annum. So it's 12 over 12. How much will it be? 12 on 7.
0.84.
Is it 0.84?
Yes.
15 on 8. Is it 0.12? Is it 0.12? 1.2. Okay, 1.2.
1.2.
Then 5%, 22% on 5.
1.1.
1.1. So am I going to add all these? I'm going to have here to be 10, 11, 3.14 million. This is the total interest for the year. I get it. This is the total interest for the year. Then now less the borrowing cost. What was our borrowing cost? The borrowing cost will be capitalized, just as we did it. It's not so much work. That's why they gave you 2 marks. It's not so much of a work. What the borrowing cost will be capitalized? Let me see. 3.56. Let me see. 3.56. No, it shouldn't be negative. Where did we make it wrong? Your 5% on 10%, 5 million 10%, 18 over 12, right? 0.75. Is that correct? Hello, is that correct? Hello? Hello? Okay, guys, can you hear me? This your figure, is it correct? Check for me whether it's correct. Can you hear me? Okay. So now let's see.
There's supposed
It says that, come again?
it's supposed to be 750,000.
So, yeah, it's correct. It's correct. 0.75 is correct. 750,000. So it says, while we began construction of a new office building on 12 January and it was completed, the revenue cost of the company 50 million. However, to allow itself some margins, Wala Limited acquired a loan of 20 million. Okay, so let's watch. I've seen where it is. So they want to construct the building on 1st January 2022. Are you getting it? And now there are 2 years, 2022 to 2020, December 2022. Okay, I'm going by the date. If the date is wrong, then our work, we have to make it per year, right? So if it's 7 million per annum, how many months, how many years are we working with? How many years are we working with? 2 years, right? 1st January 2022 to 31st December 2023. That's 2 years. So it means that it's going to be 7 million times 12% times 24 over 12. So I can report this for 1 year. Are we okay? Are we okay? It should be 7 on 12% times 24 over 12, not 12 over 12, because we are working within 2 years. So if the question is wrong, assume the question said 2022, then it should be 12 over 12. Then it means that you have to go back and change all the 18 or whatever all over. But we cannot say it's wrong because they said 30th January 2023, so it's still correct. So let's change the figure and make it divided by 12. So that should be the computation. So each of them, you make it 7 million, 7 times 12% times 24 over 12. Though it's for 2 years, we are reporting in a particular year. So whether it's the first or second year, it should be the same. Then the next one to 15% times 8 million times 24 over 12. Then the last one also. So what do we have? Let's be quick. It's more than 2 hours. 7 times 12. Come again.
1.68.
1.68. That's it. Then the next one. Yeah, it's correct here. Then the next one. Also 24 over 12 because it's for 2 years.
2,400,000. 2.40.
Boss, don't bring the million. 2.40. What next?
Mm.
Let's be quick. I'm getting tired. Let's be quick.
2.2.
2.2. So this will be 8. This will be 10. This is 12. This is 5, 6, 7. So this is the total interest for the 2 years. Because you are not working within 1 year, you're working within 2 years. So the rate must also be in 2 years. This is the total interest for 2 years. Then we will less the borrowing costs, which was 3 point. Yes.
If you add, you get 6.28. Not 7.28.
Okay.
6.28.
Thanks. Okay, that's fine. Then we will less the borrowing cost, which was what? What was the borrowing cost? 3.5675. We will less it because the borrowing cost is in 2 years. 3.5675. Don't forget they are all in millions. So let me put Ghana City here, million up there. M. We will less. We're going to have here to be 5. This should be 2. This should be 1. This should be 6.452. Is that correct? Is that correct? $2.7. Okay, yeah, 2.7. 2.7, not 2.6. Yeah, 2.7. That's correct. This is the finance cost or borrowing cost to be expensed, or finance cost to be expensed, because the construction is within 2 years. So we must acknowledge the 2-year construction phase. The first one we made it 12% times 7, and it was times 12 over 12. But it should be 24 over 12 because it's taking 2 years per annum and for 2 years. Class, are we good? Are we good? We are done. This as easy as that. We are done. So there's it. It's as easy as that. We are done. So that's all that you should know about borrowing costs. These are the difficult parts of borrowing costs you should learn. You have to consider the investment income. What is new about this is the investment income. The investment income. Okay. So you find that WACC, you need to compute the borrowing cost for the entire year. Here there was a cessation. That period, borrowing cost is not accounted for. Which of the 2 months? So you have to take it for the 24. All right, so we took it out. Then we computed the investment income on 5 million. We took it out from the 14.3175. We got 3.5678. Then the cost, we added it to the original cost of 50 million, giving us 18.5675 million. Then you have to go and find the borrowing cost to be expensed. Just similar as the first one. Any question we have ended the class? Okay. So next semester, the accounting, we're doing FR2. Very good. And we have private tuition for, those students who need private tuition, we teach them. I have free time, so I decided to host this session on Zoom. So we will notify you in the group for next semester. Those of you who will be interested, then you will join. Because we start teachings, we only make the one is getting closer to exam. They are called interventions to assess. Oh, sorry. Let's do the last part of the question. Identify any two difference between the revaluation model and the IAS 16 and the revaluation model and the IAS 40. Okay, so what are the two differences? Any two, meaning there are so many. Yes, what can you think of? Okay, don't worry, you go and